Today's session is brought to you by Emerald Financial Group. Emerald exists to help investors make informed decisions about their investments. We offer a range of services to help educate, support, and motivate everyday people to get involved in the stock market. We offer services for any experience level. Just look for the link down below in the description and you'll find a bit more information about us. Now, today I have my colleague Sam Green here with me. Sam is a equities analyst and derivatives advisor on our desk here. Very experienced in markets, very knowledgeable. So listening to what he has to say about the market at the moment and to our theme of our podcast today, we will be talking about the market right now and a little bit what's happening in the short term. We've got a fairly whippy market right now. We've come off our highs a little bit and everybody's talking on whether this is the high of the uptrend or not. So let's talk about the dynamics about what's happening here and just dig a little bit deeper. But I'll just sort of start off by saying we're in a very unique environment at the moment, okay? So we've got extremely accommodative central bank policy happening out there, something we've never seen actually in this country. We've seen a little bit of similar action just after the GFC from the Fed, but nothing like of its kind in Australia. But, you know, governments are also very willing to stimulate, right? And what everyone's trying to do is get an economic recovery, but also target inflation back to around that 2 to 3% range. And bonds on the back of this has been a massive talking point over the last few weeks as many investors are worried about hyperinflation. So Sam, just tell us a little bit about what's happening in the bond space and what your belief is in this big move we've been seeing.
Mm-hmm. Well, first of all, thanks very much for having me, Tim. And you're 100% right. We are seeing, I guess, a very large move higher in longer-term government bond yields. It started filtering a little bit into the shorter-term government bond yields. And really, it's because markets are expecting inflation to occur in several years' time. So the 5-year inflation expectations have lifted to the highest level since 2008. And that's not really something that we've seen at all recently in markets. It's caused, people to sell out of bonds. Why would you want to hold a bond returning, 1% yield, for example, when, inflation's trading higher than that, because you're effectively losing money or you're losing value on your dollars. And so that's why bonds are being sold down. People are selling them down until they'll reach a level where people are comfortable receiving that yield because it's beyond their inflation expectations. And that's generally what's going on. We have seen central banks intervene in the bond market to try and keep these yields suppressed. And it's interesting that they're now starting to talk about inflation as well. So they may be a bit more willing to let these yields, accelerate a bit further than they are now, just because they are worried about inflation, that they themselves. Now, as to whether or not this will mean a peak for the market, I think that's, it's hard to say, obviously. We have seen similar scenarios coming out of the GFC. We did see, bond yields start rising again. We did see higher inflation expectations, and markets kept going. So I don't think it's any guarantee that this is the end of, the 10-year bull run that we've seen since, the bottom of the GFC. More likely, it's a scenario where we're going to see stocks behave more on their own fundamentals. We're going to see some of the more higher value stocks start to be sold down a bit. Some of the more attractively valued stocks start to outperform, and that's really my view. It's a cycle that we move into that we saw between the year 2000 and 2008, between the tech bubble in the year 2000 and the GFC. We saw value outperform. Since then, growth has outperformed, and I think we're about to see value outperform again.
Yeah. So just to pick up on a few points that Sam just made there, they're selling in the bond space. Okay, so people are getting out of bonds because they're expecting inflation to be higher in the future. Therefore, why would you want to hold a bond if it's not returning more than future inflation? Right? It's just not a good sound investment anymore. So the move up in bonds is not the problem here. I think the extreme move up in bonds we saw last week brought a bit of fear into the market in the short term. So I guess an out of control selling in the bond market, that equals fear in the equity market. A slow, steady move up in bond yields, I think, is healthy here. Why would you worry about inflation that hasn't happened yet if you're an equities trader? The inflation's good news for you. Guess what? All this stimulus and expectation of inflation means equity prices should go up. The question is, and what Sam just scratched on then, is where do you invest your money, right? There's two things right now. For equities to go up, where would you want to be invested? And two, all this selling in bonds, where's that money going to go? Mm-hmm. Okay, and I guess that's a question to you, Sam. Where do you think that money is going to go, and when it floods back into the equity market again?
Well, that's a very good question, and I think you've really got to basically look at prices now and say, are these prices sustainable? In 10 years' time, will this stock have earned a large amount of money to justify its share price? And people are starting to look more at the inherent returns of stocks. If interest rates are zero, you can leverage to infinity into, really high risk, tech stuff, things like that. But now they're starting to realize, well, if I'm starting to pay for that leverage, if there's a cost of, of capital, you've really got to look for something that has a strong return on that capital. So we think that stocks that trade on attractive PE ratios, low price to earnings ratios, stocks that trade on low price earnings growth ratios, stocks that have high dividend yields, the traditional value stocks we think will really outperform during this period. And this is something that we talked about back in January when we touched on the rising bond yields for the first time, and that we thought they may influence the market this year. Potentially bringing an end to just the straight upwards movement in everything that we saw since the March 2020 COVID selling lows. And so that's what we're focused on, really attractively valued stocks.
Yep. So, and really from our market perspective, when you look at us, the Australian market, especially the top 200, compared to maybe the S&P 500 in the US, you'd happy to say there's a lot more value stocks in our market. We start looking at our big miners, our banks, they all really sit in that value space. So I think the Australian markets really should perform quite well in this environment compared to when growth stocks and tech stocks are more favourable. But yeah, we're definitely seeing that theme continue in the market, a sell-out of the big tech growth names that performed extremely well when everyone was stuck at home, back to value and that recovery space where vaccines are getting rolled out. We should see movement in the economy more and more over the next year or so. So anything that's going to start benefiting from that, and that's sitting in the value space at the same time, is something that you really want to start looking towards, or moving your portfolio towards.
Yeah, definitely. And I think that's a lot of what we've seen, across the recent volatility. Not necessarily just a big general sell down of everything, but people, restructuring, reshifting, as they've sold bonds down, that money has to go somewhere. And, it's people readjusting for the expectations of future inflation.
And look, at the end of the day, tech will hit a level where people want to buy again in the short term, right? So I'm not saying that tech won't move up through this period. We do think there's a rotation out of tech into value right now. When I say tech, I also mean communication services and maybe some discretionary stocks in the US as well. I'm kind of more alluding to those high growth stocks. But at some point, they will be attractive for a short-term buy again, right? And traders will jump in and you'll get fluctuations and you get your movement. So it's not all grim for those stocks. No, it's not what we're trying to say here. What I guess we're trying to say here is that the value space should start to outperform quite well in contrast.
Absolutely. And I think the past has given us a bit of a roadmap here. And there have been times where people have called the death of value. They've said, investing based on key financial ratios is dead, and they've talked like that. But, they said similar things in the late 90s, and then value outperformed for 10 years, between 2000 and 2010. So, markets do go through cycles. They don't necessarily repeat exactly, but they do rhyme. And yes, the last 10 years definitely have been a growth cycle. I think we could move into another cycle for the markets.
Yeah, especially with all this stimulus being splashed around, infrastructure spending, all that tends to move back towards value stocks.
Mm-hmm.
So definitely. So Sam, let's talk a couple of stocks that you're happy with at the moment. I know you put out a recommendation last month that's done very, very well for all of us. So let's talk that. And
so right at the end of February, we jumped in on Aeris Resources, which is a very attractively priced copper and gold miner, a producing miner, very rare for a company of its small market cap. So we put that out. Most of our clients were able to get around the 9 cent level, and we're very fortunate to be up around 30%, maybe 33% I should say, on that at the moment. And that goes along with our theme of the recovery story, demand for copper, gold as a potential hedge for inflation in future, although it is being sold down with the bond yields at the moment, and just focusing on stocks that are at a really low multiple of earnings. So Aeris Resources should earn anywhere around $80 million this year, and the stock itself is trading on a market cap of about $240 million. That's just a very, very attractive price to earnings ratio, we would say. And when we invest in something like that, we can be fairly confident that the stock can earn its price. Whereas if we're paying $240 million for a stock that has very, very little earnings, it becomes a much less confident proposition. And those are the sort of stocks we think will outperform at a time like this.
Yeah, definitely. Especially with copper up near all-time highs. Keep an eye on that copper space, guys. Copper will be in demand over the next few years. With the recovery effort, not to mention, all the batteries that are being built, electric cars, that demand for copper is going to be huge over the next 5 to 10 years. So it's a space that we're extremely bullish in and keeping a very close eye on.
Yeah, absolutely. I think it's a very strong likelihood that we see fresh all-time high copper prices this year, and I would not be surprised for them to keep going from there.
Yeah. And the other space we're always talking about at the moment is the iron ore space.
Mm-hmm.
Also, steel should be in high demand. Even as in China, the demand might drop a little bit. Around the world, there should still be fairly strong steel demand as the infrastructure spending gets distributed out there and things get underway. So, Fortescue, BHP, Rio all have gone ex-dividend recently, pulling back a little bit after all of that and coming back to some really attractive levels. So keep an eye on that space as well, I believe.
Absolutely. I think, rumours of iron ore's demise have been greatly exaggerated. We've been long the sector for 3+ years. A 50% fall in iron ore prices was once $40. It's now, $90. So it'll happen, guys. It'll happen eventually. But by the time it does, iron ore, 50% might be a very attractive price still. So
yeah.
I think you're giving up potential significant gains in dividends by avoiding the space.
Yeah, definitely. Look, I think we've covered pretty much everything we wanted to today, so thanks for jumping on. Now, if you are interested in exploring a little bit more about what we do, jump down, click on some of the links below in the description, jump on our website. We do offer a lot of courses through Trader Circle. If you want to learn how to trade, we'll teach you how to analyze the market the way we do, and we'll teach you a lot of technical analysis and different types of strategies that can help get you there. We also offer a lot of fundamental analyst tools and things like that. So have a look around. Don't hesitate to reach out, give us a ring, drop us an email, and we'll have a chat about what you want to achieve out of the market and just see where we can sort of fit in and help you out.
Absolutely. And if you're watching on YouTube, like, comment, and subscribe.
Thank you very much. Bye. Thanks, for now.
Guys. Bye.